Une incertitude accrue pèse sur notre prévision. Il y a plus de résultats possibles que d'habitude. La politique commerciale des États-Unis reste imprévisible et les risques géopolitiques sont élevés. Nos décisions de politique monétaire visent à maintenir l'inflation près de la cible de 2 %, tout en aidant l'économie à traverser cette période de changement structurel. Le Conseil de direction estime que le taux directeur actuel demeure approprié à condition que l'économie évolue de manière généralement conforme aux perspectives publiées aujourd'hui. Comme l'incertitude est accrue, on surveille les risques de près. Si nos perspectives changent, on est prêt à réagir. So let me expand on what we've seen in the economy since October and what we see ahead. Tariffs and uncertainty continue to disrupt the Canadian economy. After a strong third quarter, economic growth likely stalled in the fourth quarter. Exports continue to be buffeted by U.S. tariffs, while domestic demand appears to be picking up. Household spending is expected to continue growing moderately, supported by past cuts in interest rates and rising disposable incomes. U.S. tariffs and related uncertainty have held back business investment, but we expect some modest strengthening in investment as businesses adjust to the new trade environment and governments increase infrastructure spending. The impact of U.S. tariffs can also be seen in the labor market. Employment weakened in the first half of 2025 as sectors hit hard by U.S. tariffs cut production and jobs. In recent months, overall employment has risen, led by hiring in services like healthcare. At the same time, slowing population growth is reducing the number of new entrants into the labor market. Still, the unemployment rate remains high at 6.8%. Youth unemployment is particularly elevated, and relatively few businesses say they plan to hire more workers in coming months. Overall, economic growth is expected to pick up gradually. The Bank of Canada projects annual average GDP growth of 1.1% in 2026 and 1.5% in 2027, broadly in line with our October projection. Turning to inflation, it averaged 2.1% last year and has now been within the 1 to 3% band for 2 years. If we focus on recent movements, CPI inflation rose to 2.4% in December, boosted by base year effects linked to last year's GST-HST holiday. The bank's preferred measures of core inflation have eased from 3% in October to around 2.5% in December. The bank expects CPI inflation to stay close to the 2% target over the projection, as tariff-related cost pressures are offset by excess supply. Uncertainty around this projection is unusually high. Geopolitical risks are elevated, and the upcoming review of the Canada-US-Mexico agreement is an important risk to the outlook. It's also still too early to tell how the Canadian economy will adjust to current tariffs and ongoing uncertainty. The transition to the new trade environment could be smoother than we expect, with stronger business and household spending. Alternatively, the labor market could weaken further as trade impacts deepen, leading to lower household spending. And financial conditions could also tighten if volatility returns to markets. Considering both our baseline forecast and the risks, the Governing Council discussed the future path of monetary policy. While Council judges the current policy rate is appropriate based on our outlook, the consensus was that elevated uncertainty makes it difficult to predict the timing or direction of the next change in the policy interest rate. So let me wrap up. L'économie canadienne s'ajuste au vent contraire de nature structurelle liée au protectionnisme américain. Les entreprises réorganisent les chaînes d'approvisionnement et investissent dans de nouveaux marchés. On s'attend aussi à une réaffectation de capitaux et de main-d'œuvre quand de nouvelles possibilités vont ouvrir. Ces changements, qui comprennent des échanges plus diversifiés et une meilleure intégration des marchés internes, vont favoriser une certaine relance de notre capacité de production. Mais ça va prendre du temps. La politique monétaire ne peut pas compenser les dommages structurels causés par les droits de douane, ni cibler les secteurs de l'économie durement touchés. Mais elle peut apporter un soutien en aidant l'économie à traverser cette période de changement structurel, tout en maintenant l'inflation près de la cible de 2%. La Banque s'engage à préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversements mondiaux. The Canadian economy is adjusting to the structural headwinds of U.S. protectionism. Businesses are reconfiguring supply chains and investing in new markets. We also expect to see some reallocation of capital and workers as new opportunities open up. This restructuring, including diversifying trade and a more integrated internal market, will support some recovery in our productive capacity, but it will take some time. Monetary policy cannot compensate for the structural damage caused by tariffs, and it can't target hard-hit sectors of the economy. But it can play a supporting role, helping the economy through this period of structural adjustment, while maintaining inflation close to the 2% target. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Okay, thank you, Governor. We will go to those questions now, starting with reporters here in the room in Ottawa. Then we'll go to those who joined remotely. As usual, I'm going to ask you to limit yourself to one question so we've got time to get to every outlet. If I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier si je ne l'ai pas fait. Et comme d'habitude, libre à vous de poser vos questions soit en français ou soit en anglais. We will start with a question here in Ottawa. I'm going to start on the left-hand side of the room as I'm looking at it, then work our way to the right. So let's start with Paul Vieira from the Wall Street Journal, please.
Governor, is the Bank of Canada saying that the outcome of the USMCA negotiations is going to dictate the next move in interest rates?
Paul, what we are saying is that uncertainty around our forecast is unusually high. There are a number of risks and uncertainties. Geopolitical risks, geopolitical uncertainties have increased. They're heightened. U.S. trade policy remains highly unpredictable. And for Canada, yes, CUSMA, what happens, what the outcome is of the review of CUSMA is an important risk to our projection. I mean, what we have built into our projection is that tariffs that are currently in place remain in place. So what that means is that the tariffs on the hard-hit sectors stay, the CUSMA exemptions for everything else remain in place. That could change with the review. The other thing we have in our projection is, the uncertainty is already having an impact on the economy. That's built into our projection. We have that gradually diminishing over time. But yes, CUSMA is under review, and the outcome of that, there's obvious risks to the projection. The outcome may not be no change, and we highlighted that in the press release, and in the back of the monetary policy report. We go through a number of possible outcomes for CUSMA. I would stress that we've done a number of scenarios. They've been in our monetary policy report. We've published them in speeches as well, with a whole range of different configurations of U.S. tariffs. We've found those useful in our decision making, and I think it's never easy to manage uncertainty, but I think they do help us think through the channels and some quantification of the impacts of different CUSMA outcomes.
All right, we will go to Kevin Carmichael from The Logic next, please.
Good morning. Governor, in your statement, you talked about how the Governing Council sees the potential for some reallocation of capital and workers as new opportunities open up. What do you mean by that? What do you see there? What do you see happening?
Look, I think you're right. There's a lot packed into that. You've got a number of very hard hit sectors in Canada: steel, aluminum, lumber, auto industry. They clearly are looking for new opportunities to provide for the Canadian market. When you start to look at things like steel and aluminum, you quickly learn that, well, there's actually a lot of different products, and they may need to pivot to new markets, whether those are in Canada or outside of Canada, and that could involve some restructuring. They'll need some new capital. They may need some new skills. I think more broadly, whether you've been hit by tariffs or not, the U.S. the relationship with our trade relationship with the United States is fundamentally changed, and what you're seeing is that businesses, even if they are CUSMA compliant and are exporting to the United States, they're looking for new markets, new suppliers. The government, the Prime Minister, has been traveling around the world looking to open up new opportunities for trade and investment in Canada. Businesses are looking for those new opportunities. So, it's a combination of all those things, including opening up and reducing the trade restrictions within our country to grow the internal market, diversifying to others, and then reallocating capital and in some cases jobs to seize those new opportunities. And I guess what I would stress is that that is going to take some time. That is not something that happens quickly. And through that transition, it does lower the economy's potential growth. As that adjustment, advances, productivity growth should come back up. The economy should be stronger. There should be more resilient. That is going to take some time, and we have a 2-year projection. It's happening through that whole 2 years.
Okay, next let's go to Promit Mukherjee from Thomson Reuters, please.
Governor, between October and now, what has changed that has made you say that the range of possible outcomes are wider than usual?
Well, I mean, I think there's a few things. I think there's a sense that geopolitical risks are heightened. I'm not going to go through every event, but the month of January has been pretty packed with new elements, new geopolitical risks. I think U.S. Trade policy. There was through the last spring. There was some very big changes, some pauses, some reintroductions, some deals. Through the summer, I don't want to say uncertainty was low, but you saw a little more stability. I think recently you've seen more unpredictability in U.S. policy with all sorts of threats, including on Canada. U.S. trade policy remains highly unpredictable. And then I think, CUSMA is coming more into focus. It's now 2026. It is under review this year. So those are really the key elements that have increased uncertainty.
All right, let's stay on this side of the room. Next, I'm going to go to Craig Lord from Canadian Press, please.
Hi, Governors. Thanks for taking our questions. You've spoken alongside other central bankers in support of Jerome Powell in the United States, and I'm curious if there are implications for monetary policy in Canada if you lose confidence in central bank independence in the United States.
Well, to get back to the previous question, yes, I think the threat to independence of the central bank in the United States is one thing that has sort of been contributing to this sense of uncertainty. Look, why did I make a point of commenting on Chairman Powell and the U.S. Fed? Look, the simple reason is the U.S. Federal Reserve is the biggest, most important central bank in the world. And we all need it to work well. A loss of independence of the Fed would affect us all. And for Canada, our financial markets are particularly integrated with the United States, so it would particularly affect us. It's hard to predict exactly what this would look like, but keeping the Fed operating independently, it's good for Americans, it's good for Canadians. And let me just expand a little bit on that. It's not independence for independence sake. What does independence do? It provides central banks with the space to take difficult decisions that benefit the economy, benefit the citizens of that country over the medium term. And the historical record is very clear. Central banks with operational independence for monetary policy do a better job of delivering price stability for their citizens. Under Fed Chairman Powell's leadership, the Fed, he is doing a good job at leading the Fed based on evidence, based on facts, based on best economic judgments of the FOMC. I hope it stays that way. That's going to be important for everyone.
All right, let's now go to Greg Quinn from Market News, please.
Good morning. The revised forecast here mentions that the U.S. is putting in some robust growth this year, and inflation is high, but it's moderating. So, in a sense, is Donald Trump being vindicated about tariffs? Do they in fact not do much damage to the American economy, at least?
The bottom line is it's too early to tell, Greg. Just as it's too early to tell in our economy, these things feed through gradually. I think particularly over the last year, I think businesses, both in the U.S. and outside the U.S., I think we were all surprised by the initial announcements of U.S. trade policy. And I think there's been a period of time where businesses are waiting to see what actually shakes out. And the constant changes, the constant announcements, the threats, the rollbacks. I mean, if you're a business, you're kind of waiting to see where things level out. So I think you're going to need to wait to see what the long-term impact of these policies are. You've also got other things going on in the U.S. that are affecting the economy. There's this big investment in AI that's driving a lot of growth. So you kind of have to separate what's driving the growth and what might be holding it back. So.
All right, let's go now to Eric Hertzberg, please, from Bloomberg.
Hey, good morning. Can you guys give us an update on how you view the rollover risk for mortgages for Canadian households, given the recent uptick in terms of longer-term rates? How do you view that at this point?
I mean, I don't think we've got a big change in the comments we've given you in the past on this, Eric. I mean, this is a big year for mortgage rollovers. I think it's the biggest year in decades in terms of the number of mortgages that are rolling over. We do expect those rollovers to see payment increases, in large part because a lot of them were taken out in a very low rate environment. The recent sort of uptick in the yield curve will maybe marginally add to that payment increase, but most mortgagors have been preparing for this payment increase for a long time. The fact that rates have come down has meant those payment increases will be smaller, but we'll continue to watch it.
All right, next I'm going to call on Jordan Gowling from the Financial Post, please.
Good morning. You said the effort to diversify trade and integrate internal trade will, quote, support some recovery in our productive capacity. Is that an acknowledgement that the diversification push away from the U.S. will only partially offset the trade war impacts?
Yeah, I think you basically got it. I mean, if you look at the we published these charts several times. Sort of here's the Canadian outlook without tariffs. Here's with U.S. tariffs, and you see the reality is there's more trade friction. The economy works less efficiently, and that puts the economy on a permanently lower path. Now, you can on that, yes, it's lower, but how much lower it is going to depend on your restructure, how much you restructure. As you adapt, as you diversify your trade, as you develop new markets, as you could certainly. I mean, there's estimates that suggest that you could offset the U.S. tariffs if we completely opened our internal trade. So there are things you can do. That we'll see exactly where we end up, but it's pretty clear that the days of open rules-based trade with the United States are over. We need to get on and adjust to that. We'll be better off if we adjust than if we don't. But I mean, clearly, the end of open rules-based trade with the United States is not a good thing. It's not a good thing for Americans. It's not a good thing for Canadians.
All right, let's go to Mark Rendell from the Globe and Mail, please.
Thanks for taking the question. I'm wondering, in terms of the U.S. dollar right now, what's happening there? Obviously, there's been significant weakness in USD recently. I'm wondering, first of all, what you think is driving that. Secondly, are you concerned at all at a moment of export weakness that the Canadian dollar is appreciating against the U.S. dollar? And is that something the bank would ever lean against?
Well, look, I mean, first question, first part of the answer, Mark, is as you're well aware, we don't target the Canadian exchange rate. The flexible exchange rate is an integral part of our inflation targeting regime. So yes, the Canadian dollar will fluctuate. Actually, if you go back sort of for the whole period since October, Canadian dollar has been pretty stable around relative to U.S. dollar at about 72 cents. Yeah, in the last couple of weeks, you've seen some renewed U.S. dollar weakness, and so many currencies, including the Canadian dollar, are appreciating somewhat against the U.S. dollar. What's driving that? I think it's largely geopolitical events, and that's really been whether it's trade or other geopolitical events. If you go back over the past year, where you've seen movements in the Canadian dollar, in particular where you've seen movements in the U.S. dollar, it has largely been driven by trade or geopolitical events. They're not being driven very much by commodity prices, interest rate differentials, the sort of normal types of things that would drive the exchange rate. Look, I mean, I think the only thing, it's hard to comment on near-term volatility. We'll see what happens. I will say more broadly, the U.S. dollar has depreciated over last year by about 10%, and I think what you're seeing is that international investors, they still want exposure to U.S. equities. U.S. equity market's been strong, but that safe haven role of the U.S. dollar has been dented. People don't want as much exposure to the U.S. dollar. They're hedging more of that. That is being reflected in the value of the U.S. dollar. And at the same time, you're seeing other safe havens, most notably gold, up a lot. But what happens next?
Okay, we've got one more question here in the room before I go to the phones, and that is from Mackenzie Gray of Global News. Go ahead, please, Mackenzie.
Hi there. In the economic activity section of the NPR, you say that GDP grew by 1.7% in 2025, essentially flat on a per-person basis. Are you saying that basically immigration has been able to prop the Canadian economy up and broadly, in terms of the cuts that we've seen in immigration, how do you view that filtering its way through the economy?
Well, if you have more people coming into your economy, you have more workers and you have more consumers. So that'll grow your economy. If you slow immigration, you've got less new consumers coming in and less new workers. And so, yes, we are seeing the impact of that. It does mean a lower potential growth. It means sort of the run rate the economy can grow without causing inflation is lower. If you look at our projection, actually we have very low population growth over the projection. And potential growth is about 1%, so it's mostly productivity. You do see some, what that means is what's increasing consumption is mostly increases in consumption per person. So it's not being driven by adding consumers, it's being driven by each person's consumption going up on average.
Okay, we're going to go to the phone lines now, and those reporters who have joined us remotely, I'll just remind you folks, please, to come off mute only to ask your question and then go back on mute as soon as you're done. That way everybody will be able to hear the response. I got 4 folks on the line. I'm going to start first with John McFarland from Yahoo Finance before going to Anna Pereira from The Star. So John, to you first, please.
Hi, thanks for taking my question. You described the uncertainty as heightened and the range of outcomes as wider than usual. So practically speaking, does this elevated uncertainty create a higher hurdle for moving rates in either direction? Or does it suggest you might need to react more aggressively or earlier if data breaks one way or the other?
Well, let me just say a few words perhaps about our Governing Council deliberations, how we're thinking about it. We did discuss the future path of interest rates in our deliberations, and bottom line is we agreed that the current policy rate is appropriate if the economy evolves broadly in line with the outlook we just published. But we also recognized that, as you just said, uncertainty is heightened. It's unusually high. There's a broader range of possible outcomes. And so against that background, as we discussed it, the clear consensus was it's very difficult to predict either the direction or the timing of next move in our policy rate. To put it a bit more technically, in order to assign probabilities as to the direction of the next move in the interest rate, you need to be able to assign probabilities to the risks. And I think the way we were feeling is given high uncertainty, that's difficult. So I think that the real takeaway is, yes, uncertainty is high. We are monitoring those risks very closely. And if a new shock comes along or an accumulation of evidence that materially changes our outlook, we're prepared to respond. So, we are very alive to those risks, but we need to see, if something crystallizes, we'll assess the implications for the projection, and then, yes, we'll be considering what the monetary policy implications are.
Okay, we'll go to Anna next, followed by Max Sato from Mace News. Anna?
Hi, good morning. My question is also about uncertainty. So you keep repeating it's too early to tell how well the economy will adjust to uncertainty. But, we've been living under these conditions for a while now. You have 1 year's worth of business and consumer surveys showing how people have been responding to uncertainty and tariffs. I was hoping you could characterize the level of uncertainty for us. Would you say it's higher than it was a year ago?
Well, it's hard to parse exactly every moment in time, but it's high. And I think I've gone through in a fair amount of detail what the various sources of uncertainty are. I do think, though, that it is important to sort of step back from the kind of daily noise. Some things are clear. It's clear that the era of open rules-based trade with the United States is over. It's clear that our population growth has come down and is going to stay lower. It's clear that new technologies, particularly rapid advances in AI, have the potential to have a significant impact on businesses, on the economy. And whether you're whether you're a business trying to chart the way forward or you're a policymaker, those things are clear. The Canadian economy needs to adjust to those things. We think that has started. We think it's going to take some time, and through that period, growth will be modest. If we do adjust, the more we adjust, the stronger the economy can be, the more resilient the economy can be going forward. Central bank is not at the center of that. We can't. We're not at the center of that, but we can play a supporting role. And as we consider our monetary policy deliberations, we're basically trying to provide some support to the economy to help it through this transition, while making sure that we maintain inflation close to the 2% target.
All right, we'll go to Max next before wrapping up with Rob McClister. Max.
Thank you, Paul. Good morning, Governor. In your outlook, the positive contribution of consumption to GDP for the next 2 years is weak, while the net export contribution seems to pick up this year and improve substantially in 2027. So what are the main drivers behind those changes in consumption and net exports, including expected weaker imports, and what new export markets do you expect to see? If you can give us some examples, like by country, by goods and services, and if you can think of any risk to outlook that you might have left out or didn't discuss much in the NPR and your opening remarks. Thank you.
Those are 3 questions.
I can let the Senior Deputy Governor talk about everything I left out.
Well, I mean, just going back to the last couple of questions about uncertainty, I mean, I think that's one of the reasons why we feel uncertainty is elevated. Just when we think we've thought of everything that could possibly hit us, something new happens. So, I mean, the uncertainty is there around U.S. trade policy, and then more recently it's been around U.S. foreign policy. So, I mean, the reason something's a risk is because you haven't thought of it. So there very well could be things we haven't thought of inside that already sense of elevated uncertainty. Do you want to take the question?
Well, I mean, in terms of if you look at exports, the level of exports, at first they went up a lot as businesses tried to get ahead of the tariffs. Then they've subsequently gone down. And if you go back to before they went up, they're down about 4%. Going forward, we've now got them, returning to some modest growth, but they're growing along that path that's, roughly 4% lower. We have seen some adjustment. Companies, you see this both on imports and exports. We're importing less from the United States. We've found other suppliers, companies have, and we're exporting more to other countries. And I think there's a chart somewhere in the NPR that shows that our exports to other countries have gone up. Now, 75% of our trade historically has gone to the United States. So, it takes a lot of growth of other countries to fill in for the big drop we've had with the United States. So it's only providing some partial offset. When we talk to companies, what we hear is that so far it's not so much about finding whole new markets. It's more about discussing with the clients they already have and exporting more to those clients. There is certainly the potential going forward to actually develop new markets, and that is part of that structural adjustment. On business investment, it's certainly being held back by all this uncertainty. If you're a business leader, look, it is very hard to decide how to allocate your capital against this background of uncertainty. Having said that, I think companies increasingly are seeing that the days of open trade with the United States are over. They are starting to adjust. And as they do, that will be reflected in their business investment decisions. Governments have also increased their infrastructure investment, and they've also introduced a number of incentives to incentivize business investment, and particularly to help companies that need to pivot. So those things all together, we think, with some recovery in exports, combined with government incentives, we expect to see some pickup in investment, but it does take some time.
Okay, and we'll wrap
So
it
just
up.
just to clarify, the weaker imports is because of weaker demand here? Or?
Well, there's a bunch of factors. Part of it is, most countries export or import with the United States. Canada and U.S., we build stuff together. So when we export less, that means we also import less, because there's less stuff going back and forth across the border. That's part of it. Part of it is diversion. Some goods that we import from other countries traditionally have come through the United States. So, goods coming from China might come through the port of LA and then up to Canada. That was the most efficient transportation route. But now that those Chinese goods are hitting a big tariff at the U.S. border, it makes more sense for them to come directly to Canada. So that shows up as less imports. Even though the original source was China, that shows up as less imports into Canada. And then part of it is companies just want to find more reliable suppliers. They're looking to, they don't like dealing with trade uncertainty. They're looking for suppliers they can be more confident in going forward. So it's hard to separate all those things, but there's quite a few things affecting imports.
Okay, and we will now go to our final question, and that's from Rob McClister. Please go ahead.
Good morning. You mentioned that an independent Fed is good for Canadians. Is that because it would likely keep U.S. inflation lower and therefore indirectly help keep Canadian inflation lower, and other things equal? How should Canadian borrowers expect our monetary policy to be impacted in the case where concerns over U.S. inflation deficits, Fed independence, and so on start driving up American rates?
I think I've done my best to answer that question, so I can ask the Senior Deputy Governor to take it.
I mean, the answer to all of those things is, those things factor in. I mean, as the governor said, the bottom line is a strong Fed benefits pretty well every other economy in the world, but most definitely it benefits our economy. A strong Fed keeps the market stable, it keeps inflation stable, and all of those things contribute to predictability and less sort of volatility in rates, just as you said. So yeah, it's there's a lot of reasons for having a strong independent Fed.
And that'll do it for today's press conference. Thank you, Governor Macklem, Senior Deputy Governor Rogers. Thank you all for joining us and for tuning in today. We will see you next time.
Thank you, and thank you for all coming in a snowy January. See you in the spring.